Admission recording. Okay. So today on episode 10 of Trustasea Podcasts, we are joined by Mr. Krishnam Raju Datla, a SEBI Registered Investment Advisor and financial planning professional with over 7 years of experience helping individuals and families build structured, goal-based financial plans. An MBA in finance from NMIMS, Mr. Datla follows a fee-only, zero-commission advisory model, helping clients make informed financial decisions without product-driven recommendations. His areas of expertise include comprehensive financial planning, retirement planning, direct mutual funds, portfolio construction, tax optimization, debt management, insurance planning, and equity advisory. Beyond individual advisory, he also conducts corporate financial wellness programs, helping employees improve financial awareness and make better long term money decisions. Thank you, sir, for coming on our podcast as a guest. I would like to begin with a set of questions.
Thank you, Raghav. Thank you for a detailed introduction of me. Thank you for having me on the podcast, first of all. Yeah, so we can start.
Okay. So the first question I have is that many young professionals obsess over increasing their income. At what point should they shift focus from earning money to managing money better? And how do you actually balance both?
Actually, earning better. See, we all have a tendency to earn better. But I personally feel that earning, of course, it increases your origin. But saving habits or saving better management of your finances is where you build your foundation.
Yes.
So while it is necessary to build your career in the streams of your income and all, it also very essential to build an essential investing habits at an early stages of the career.
Yes. Sir, so if like someone receives their first salary today, what are the three most important financial decisions they should make within the first 90 days that will have them the biggest long-term impact?
Uh, I would recommend, out of the first three, I would recommend those guys to separate the investments for the salary account. So whatever you are investing or you want to save, put that into a separate account from your salary account. So that creates an immediate segregation of your investment portfolio or your savings from your current income, which is ready to expense. Okay. Second thing would be most of us are not aware of this, but insurance planning should be a mandatory thing because at an early stages, let's say if you are in your 20s or mid 20s, late 20s even, so insurance premium would be very low compared to what you require at a 35 or 40 years. So do not complicate your insurance planning. Just stick on to a simple term and health insurance. Again, what happens? Most of the professionals I speak to, even most of my clients, are mostly dependent on their corporate health insurance cover. So I would personally recommend them to have a personal health cover, apart from the which corporate is providing. Third thing would be starting the investment, even if it is a 500 rupees of SIP or 1,000 rupees SIP. So start your investment journey. The starting of your journey is not about wealth creation; it's about building a habit of saving and converting the savings into investments. I would personally recommend these three things for within the first 90 days of their income.
So that was a very insightful answer that you gave. I'd like to ask you the question that what simple budgeting system or rules should freshers follow to avoid lifestyle inflation, especially in expensive cities? How should they track their expenses practically?
So, in order to have a simple budgeting system, because we are not speaking about the experienced professionals or higher income individuals. So, always going by the textbook rules doesn't apply. When they are in a corporate or a metropolitan cities, we all know that textbook financial rules doesn't practically apply. But at least try to save at least 15% of your savings of whatever you earn. So let's say you're getting your salary created on the first of month. Transfer the 15% at the initial day or then salary creating day into your savings account, which we spoke about in the first. Priorly, we are keeping a separate account. So we can transfer that. That creates a planning of what we can do going further. It might go stay in your emergency funding building, or it might stay to your investments. That is a secondary part. Yeah,
Sir, like what should young professionals build? You know, what security they should keep for as an emergency fund, and how much is enough as an emergency fund in this uncertain job market area, like regarding AI and all that. So, what should be the
Yes,
amount?
yes. So 6 months is a standard criteria where we would be saying to keep an emergency fund aside, which is 6 months of your salary basically. But I would personally recommend if you're into higher jobs uncertainty sectors like IT and all those, I would strongly recommend to keep a 9 month as a standard figure. So it is not necessarily to keep the entire 9 months in a moment's notice of accessibility. Let's say it's not required to keep the entire 9 months into your savings account or a liquid funds which can be withdrawn in a day or
Hmm.
we can again create a multiple baskets in the emergency panels.
Hmm.
Let's say we target to keep 9 months of our income as an emergency fund, we can build into three buckets.
Hmm.
So let's say on the given month, someone has lost their job or someone is looking to switch their career. Okay. It doesn't necessarily mean that they require the 9 months fund from the day one.
Hmm.
So we can keep 3 months of the emergency fund with an accessibility of 24 hours or 1 to 2 days. The next 3 months can be having an accessibility of, let's say, 1 week. The last 3 months can be into an FD
Hmm.
with a 30-day maturity period. Because that, whenever if you want to break your SIP prematurely, you are going to miss only the last 30 days.
Hmm.
So you are earning better returns at the same time, you are having a liquidation, which is the main purpose of emergency fund.
Hmm. That was a very nice and insightful answer. Sir, like young professionals, like also like who are doing MBA and all that, they often struggle with whether they should prepay their education loans or should they invest the money in the initial phase of earning. What should be a priority for them?
Actually, this is one of the question I get frequently asked. So I have three follow-up questions for that. What was the interest rate
Hmm.
on your educational loan? Does it have any educational benefit or a tax benefit on that, like ATC?
Hmm.
And does this affect the moral complex of the person? For example, let's say the home education loan is less than 10%. Okay, with tax benefits, it could translate up to 6 or 7% return, effective returns
Hmm.
with tax benefit. So it's up to the investor and the amount of loan which is outstanding.
Hmm.
Even though sometimes what happens, we are comfortable having a mathematical equation of these equations.
Hmm.
So let's say even the outstanding is into 5% or 6% effective interest rate, but the moral complex of having a debt burden is not comfortable for many. So at that time, I would recommend them to repay the loan first. If it's not the issue of interest rate and moral complex, then we can alternatively discuss about the which asset classes are suitable to the given scenario.
Understood. Sir, is SIP still the best way of investing for your major life goals like buying a house or retirement, or are they or is there any better way or better way of going about the investment journey, or are SIPs still the best way?
IPs are the best way for long-term investments, I would say. But whatever the time horizon and the goal needs to be fixed. Let's say we cannot randomly say we are going to invest 10,000 rupees and we are going to use that for all our goals. We need to have an assigned particular lump sum or an SIP to a particular goal and a time horizon. Let's say we are investing for our marriage fund. Most of the young professionals right now are funding for that. So we will create a separate portfolio for your marriage and given the time horizon. If down payment for the house is the goal, we will create a separate portfolio because segregation of a portfolio level assigned to goals and time horizon works better for and plain, yeah, we are going to invest 20% into some SIPs.
Hmm.
That doesn't work.
Sir,
So you will have, sorry to cut you. So we will have a clear picture of what to break and when if we done a segregation at a goal level itself.
Sir, I wanted to ask that how should a young professional approach asset allocation, like into mutual funds, into recurring deposits, into bullion like gold and silver, or like like the National Pension Scheme (NPS). So how should they decide like on the asset allocation part, like what to allocate more to and what to allocate less?
That's a very interesting question. And asset allocation is something which we usually misplace and give least importance. So whenever I interact with investors or they come to know about my profession, they ask what are the best mutual funds to invest right now.
Hmm.
So mutual funds or investments right now, let's say for the last 1 year, gold is performing well.
Hmm.
Um, Equities are not due to global scenarios and market. So asset allocation needs to be tighted on the portfolio and risk taking capacity of the investor. So again, early young professionals who are unmarried, there are no dependents. So
Hmm.
they can actively invest in aggressive into equity, but not 100% of equity is not recommended to anyone.
Sir, do you feel that keeping money in REITs and InvITs, that is a real estate investment trust and infrastructure investment trust, so do you think that is also a good area to explore for young professionals, or should they leave it for the more matured individuals on the market to invest in?
Actually, REITs and InvITs are something that young professionals can consider. Let's say if the risk appetite is low, we are speaking about a moderate investor or a conservative investor.
Hmm.
We can actively invest into REITs and InvITs up to 30% of their portfolio. If we are speaking, even if we are speaking with an aggressive mindset, we can consider risk of REITs and InvITs because here the young professionals are not into higher tax brackets at this moment.
Hmm.
So REITs and InvITs only have a disadvantage in the hands of investors of getting taxed at a highest, whatever the tax slab rate are there.
Hmm.
So that is a wonderful opportunity rather than buying a physical real estate. I would strongly recommend to explore REITs and InvITs for this option.
Yes. Sir, I wanted to understand what is the clear indicator or parameter to understand whether somebody has attained the financial independence. So, what is the like threshold or what is the milestone that one should think about when they hear a term like financial independence?
Financial independence have a different goals. So someone wants to have a debt-free lifestyle with own home and a decent car is once a life settlement. So someone needs a regular inflow of cash. So we cannot have a defined parameter for that. It usually depends on whatever the person is considering. So early retirement is something we all are exploring as this generation going forward. I'm hearing a lot of about early retirement is always on the cards.
Mm,
So given that scenario, whether we are able to sustain the lifestyle going forward, calculating the inflation accumulation and all,
mm.
the figure will tell us whether we are financially free or not.
Sir, if you are to, in a very simple manner, explain the power of compounding to our listeners, so what would that be? And with a small example, maybe if you could explain it.
Well, so power of compounding, I'm not going into mathematical formulas right now to keep it simple.
Hmm.
So the power of compounding is where you are, as we are speaking about building habits, right?
Hmm.
Essential lifestyle habits. Let's say early retirement or a retirement planning. What happens usually? A 25-year-old does not think about retirement plan
Hmm.
until and unless he is 45.
Hmm.
Power of compounding explicitly works beautifully in the early stages of life. So whenever a 25-year-old comes up to assign some goals for his retirement, initial amount or a burden or outflow of the cash, we would say, will be very limited. Let's say starting at a 25 or 22 or 25 years of age, the investment, monthly investment with somewhere around 4 to 5,000 rupees
Hmm.
with a step up SIP of 10% is sorted. He is sorted for his retirement plan.
Hmm.
Whereas 45-year-old
Hmm.
will have only 15 years of lifestyle with dependence on his hands because at 45 we'll have children. We'll be having dependence on marriage or parents will be dependent on us, which may so this is a different lifestyle. And given the market scenario, there could also be a transition phase.
Hmm.
career switching or transition phase, which is also a riskier thing.
Hmm.
So having a time horizon of 20 years to 30 years time horizon requires a very minimal amount.
Right, right. So, sir, does that mean that like our principal and our interest, it also gets reinvested every year? Like, is that an important part of the compounding factor?
Yes, it's very important in the compounding factor, but I want to clear a misconception here.
Hmm.
Most of the investors consider SIP investments to compound
Hmm.
to get a clear picture. But to explain you, SIP doesn't work on a compounding factor. It works on a rupee average costing. So what is the principal formula behind compounding? The interest we earn this year will be
Hmm.
fixed, and the next year interest will be compounded to our principal. That is the basic thing.
Hmm.
But whenever you come to
Hmm.
equity mutual funds is not going to yield you a certain return.
Hmm.
That completely depends upon market fluctuations.
Yeah.
So whatever the monetary value you are getting, it's not yours
Yeah. Yeah.
until and unless you get your investment back.
Right.
So what happens? It gets rupee costing average.
Hmm.
So that is how the compounding reflects into mutual funds, but the actual compounding doesn't work in equity mutual funds.
Hmm. Understood, sir. Sir,
Yeah.
what is one popular financial belief or advice which is widely accepted by the public that you, as a SEBI registered investment advisor, strongly disagree with? So, something which is accepted by the
Yes.
general public as a fact, but you know as an insider that it's not true.
Physical real estate is always a safe haven
Right.
because I would say whenever you are in any professional earning, let's say for a decent amount for the last 2 years, the
Hmm.
first thing the markets, your relatives, your parents might be your associate people. What happens? You are pushed actually to buy a own house
Hmm.
even at a emis of 50 to 60% of your monthly income source goes into a single asset. We
Hmm.
call it an asset, but I personally call it a liability
Hmm.
because we are having an outflow cash here.
Hmm.
There is nothing inflow to call it an asset at this moment.
Hmm.
Okay, we are actually locked our commitment for the next 20-25 years given the
Hmm.
property valuation.
Hmm.
So what happens? You are not building any of the foundation. You are not planning your insurance, neither your retirement plan. You do not have any digital assets at this moment.
Hmm.
It may be savings or whatever. Let's say
Hmm.
uh, I, as a Krishnam, I do not have any asset, but I have an 1 crore rupee, 1 crore of flat.
Hmm.
Okay. What good does it make for me or the real estate investment
Hmm.
for the 1 crore rupee if I am not able to use it for
Hmm.
my emergencies? Or let's say I might have a minimal requirement of 20 lakh rupees
Hmm.
for some medical expense or some other unfortunate or foreseen expense,
Hmm.
the basic expense of a lifestyle expense.
Hmm.
So it's an illiquid asset, which is actually draining our savings ratio and
Hmm.
also our potential to earn better returns.
Hmm.
So I personally do not consider physical real estate at buying that at a 50 to 60% of EMIs from
Hmm.
your current salary. That is not an asset.
So what should be the limit? Like it should not cross this a certain percentage. So what should be that percentage limit that from your total income, like monthly income, that should go in a EMI for a house?
None of your accumulated EMIs,
Hmm.
not only for the home, accumulated EMIs should not be more than 40%.
Hmm.
The home loan, if you are only having home loan and a credit card, because again, I'm stressing on that credit card is compulsorily used by these professionals and everybody is using credit card right now.
Hmm.
So having said credit card aside, EMI should not be more than home EMI should not be more than 30%.
Okay, okay. So, do you believe in the like in the youth people doing a lot of credit card payments, and they're also thinking about assets like crypto to where they think they can earn a big money very soon. So, what is your viewpoint on these things like these fads among the youngsters or something?
Yes, yes. See, investing in these accumulations without any regulatories, the
Hmm.
return does sound fantastic.
Hmm.
but what is the safety net we have behind that?
Hmm.
So what is the regulatory body?
There's none, I think.
Do how many, yeah, how many of you do we really understand the working of crypto before we invest?
Hmm.
See, none of everyone are fascinated about the return,
Hmm.
but none of them really understand what is the underlying reason because behind the crash or the running of bullish run or bearish in the cryptocurrency.
Hmm.
So I personally feel that we can invest, but only we should invest in what we understand. What is the underlying basics? If we understand, you can invest.
Hmm.
Do not just fascinated about the returns of
Hmm.
getting double your returns. That doesn't apply.
Hmm.
That doesn't work on the physical world. Investments must be boring, actually.
Hmm.
If that is something it's getting you excited,
Hmm.
please consider the asset class. The same thing, yeah, the same thing goes with the futures and options. I
Right.
see a lot of people having an futures and options funding
Hmm.
in 1 lakh, 2 lakh, 10 lakhs, 15 lakhs, but the underlying investment asset, the core portfolio
Hmm.
is not even 10 to 20,000 rupees.
Hmm. Right. Right.
So the returns are getting exciting these guys, everyone.
Hmm.
So consider what is the underlying, what is the safety net do I have behind the investment
Hmm.
or behind this particular asset class? That needs to be answered. And also, I would like to point out one thing. India needs to have an ecosystem where they can find a reliable advisor for themselves.
Hmm.
Because let's say we are having some health issues.
Hmm.
We are having a certain doctors for a specialized, for every organ, we have a specialized doctors here.
Hmm.
Okay, we understand whom to consult.
Hmm.
But in the financial industry, what's happening right now? The investors are unaware whom to choose as an advisor.
Hmm.
Because I personally getting calls that we will be handing you the trading tips. You just invest the money and we'll handle the accounts. So they
Hmm.
are calling me personally, stating that
Hmm.
we are a fund investment advisors on that.
Hmm.
We need to check the credibility and we have to have an ecosystem.
Hmm.
Whether they an investor, an retail investor, majorly can find a reliable advisor they can depend on.
Hmm. So for all your clients, like when you conduct advisory and all that, what is your underlying methodology that guides the the consultation that you give to your viewers? Like, what is your a framework that you follow, like when you try to understand the needs of a client and how
Yeah,
to guide them?
uh, I work on a five-step framework.
Hmm.
Whenever an investor comes to me, the first thing I cover is their insurance requirements.
Hmm.
I do a thorough insurance analysis on them, whether they are under, and I don't want my investors or my clients to be
Hmm.
underinsured or overinsured at the same time.
Hmm.
I do not fantasize them with these ULITs, endowment policies, money back policies, and all.
Hmm.
We can keep our investment portfolio very clean and simple.
Hmm.
That will be the first step. Insurance planning will be the first step. Second will be the risk profiling and understanding their financial goals.
Hmm.
So most of the retail investors are investing their hard earned money to fulfill their financial goals at some point of time.
Hmm.
So they have to have a clear picture of what are their goals, what return needs to be getting on that. Does the risk exposure is necessary or it is really necessary to get certain risk? So
Hmm.
let's say an investor can achieve his financial goal at a 12% return.
Hmm.
Okay. Why to expose him to an higher risk to just to fantasize him with a better returns? Let's say heavily investing in small cap, but
Hmm.
his financial goals is very sufficiently getting fulfilled at 10 to 12%.
Hmm.
So that will be the second step. Second step is where we will be learning their requirements and risk appetite. Third step is where I build the permutation fund combinations of their asset portfolio. I build two portfolios for them. One will be a core portfolio and one will be satellite portfolio. That depends upon the market scenarios and all. The satellite portfolio gets revolved around the core portfolio. After that, the fourth will be actually implementing the portfolios. executing the financial planning. What is that? What will be their debt management requirements? And what finally the retirement planning and execution of each and financial goals appropriately, and assigning each goal will be the last step.
So this is a very detailed framework that you have developed. I'm sure people must be benefiting a lot from this. My final question to you was that do you think patience or is the most important quality that a Indian investor must have for getting good returns over a period of time, or is there any other quality which is differentiates the successful investors from the ones who don't get much returns from the investment?
Patience is definitely an a crucial factor for any investment asset class. Whether you deal in equity, you deal in debt, the patience is a core foundation, and also having a clear analytical approach about the investment asset classes. So you cannot rely on any one words. You need to understand where your money is going. So when we spoke about diversification, having 8 funds in your portfolio doesn't diversify your returns. Having a different asset allocation with a proper asset allocations, and also having an overlapping investment or a funds that actually yields you better returns. And we are not jumping every year here and there about what are the best performing mutual funds in 2026. We are going to stick on to the core portfolio of what are the funds or what are the sectors that these fund managers are actually concentrating on. That is where the patience and analytical mindset, the reason behind why. So I clearly stress out on every client of mine to ask me why. Whether I might recommend you an asset class, whether I might recommend you an proper fund name or an insurance product. I want my friends to, my clients to ask me why. Why is this advisor? Why is my advisor choosing this particular fund?
Sir, is there any book that you would like to recommend readers to read for understanding or growing the knowledge about investing? Is there any book or thing or a website that you think is insightful to the young investors?
There are a lot of books actually. I would strongly recommend you to go with a Psychology of Money. It's a very common book. We all know the title of the name, but it talks detailed into what needs to be considered about the money. That's a basic book you can start with.
Okay.
And going forward, if you are interested into analyticals on, you can find very detailed books on that.
Okay. So starting with the basics, making our basics strong, and then building on it with our experience and efforts.
That is where the entire your financial bungalow or villa stands on. So the foundation is very crucial for that.
Thank you so much for your time today, sir. And I'm very grateful to you for being our guest today. And have a great day.
Thank you, Raghav. Thank you.
Thank you.